One of the questions I get asked after making this video about SIPP and also after talking about my private pension so much is, how do I claim the additional tax back as a high earner? Let's take a look at this today. Welcome back to All the Honeys. I'm Marta and I'm very excited to have you here. Before we look at the actual process of claiming that additional tax back, we need to mention what a SIPP is and how these government top-ups work. A SIPP is similar to an ISA in that it's also a wrapper. I talked about ISAs, particularly the stocks and shares ISA, in this video. So if you have questions about it, you might want to check it out. SIPP stands for Self-Invested Personal Pension. So it's a wrapper that was designed with one goal in mind: giving you income in your retirement. I've been asked many times why I choose to invest in a SIPP. For me, somebody who doesn't have a work-based pension, SIPP is the closest way I can get to that free money that employees get as one of the perks for working for somebody else. When you're on your journey to financial freedom, you want to make sure you use every single little help available to you at that time. These benefits will change when your circumstances change. For example, you might be contributing as much as possible to your pension as an employee to take advantage of matched contributions. And then later, when, let's say, your side hustle takes off and makes you more money than your job and you decide to leave and start your own business, you might want to open a SIPP and lower your corporation tax that way. With the private pension, every time you put money into it, the government will treat you to a top-up. Well, more of a tax return, but more on this later. This top-up depends on your income. And this is the moment when we look at the chart of income bands in the UK. Woo-hoo! Okay, here it is. The first 12.57k is tax-free. Then anything above this and below 50.27k is taxed at a basic rate of 20%. Next, we have the higher rate of 40% on anything you make above that and below 150k. And finally comes the additional rate on anything you make above that 150k, and that rate is currently 45%. Now I need an example. Talking without examples simply doesn't cut it, does it? And we'll need that example in a second, so listen up. Meet Ginger. Ginger has a cool name and works as a pet fashion designer. No, you don't want to Google it to see if it's a thing. Ginger makes 55k per year. Question: how much income tax does Ginger pay? 22k, 8.486, 9.428, or 16.972? The correct answer is C. First, we look at her salary. So it's 55k, and we quickly decide where it's placed on the tax bands. So it's right after the first bracket of the higher rate, right? To work out Ginger's tax, it's best to start from the end. What also helps is to think of it as a roll of dough ready to be cut into pieces. So let's take Ginger's pay, 55k, and cut off that bit sticking out to the right into the high rate tax region, okay? That's 4.730. She will pay 40% tax on that. What we do next is we cut off the tax-free bit, so the left ending of our roll of dough, okay? And we're left with the middle bit, so the one taxed at 20%. I know for a fact that many people are really confused by the higher tax rates, so wanted to make sure that we're on the same page here before we move on. Back in the world of our private pensions, this is the bit when we need our bit of knowledge about the tax income rates. Tax, SIPPs, incomes, all this can be overwhelming at first. And money is very emotional. One of my clients has this funny way of exclaiming, "How come I did not know this sooner?" Just in the middle of our coaching sessions. I love it when she is so outraged by her lack of knowledge. At the same time, picking up new skills during our work together. If you want to work with me, you can find my current programs on my website, and you can find the link below. Let's rewind for a second. With the private pension, every time you put money into it, the government will treat you to a top-up. That's right. As a basic rate taxpayer, you will get a 25% top-up from the government. So, if you pay £100 into your SIPP, you will get £25 from HMRC. Now, you might ask, wait a minute, 20% of £100 is £20. Are we getting some amazing, not planned for by HMRC bonus here? Well, no. Any money that you put into pension should not be taxed in the first place, simply because it's exempt from tax. Now, that money you paid in, that 100, had already been taxed. If you hadn't paid tax on it, your 100 would have been 125. That's because £125 taxed at 20% is 100. So no mistakes and not much of a bonus really. But you know what? As a rule, my goal is to show up in life with gratitude. So let's see this as a form of generosity. And the generosity doesn't end here. You virtually have no work to do to get that money back. The top-up is arranged between HMRC and your pension provider. You do zero work. Say my SIPP is with Vanguard, so all I need to do is wait a few weeks for the money to appear in my pension account. That's it. Simple. Now, what's equally simple, but often missed by higher rate taxpayers who make significant contributions to their private pension, is the second tax relief. Let's see how it works in case of Ginger. Ginger put in £10,000 into her SIPP. She gets the 25% government top-up automatically on the whole 10,000. So 2.5K. Now, we know that Ginger paid 40% income tax on the 4.730K from her pet fashion design earnings. This means that she can claim additional 20% from HMRC on that money, about £1.182. If you like Ginger or an additional rate taxpayer and you want to claim that extra tax back, here's what you need to do. First, get your numbers ready. Take a look at your annual pension contributions. Right now, my only SIPP is with Vanguard, so I can show you how I found mine. You go into Documents on the left-hand side, then the Documents tab, and here you can see the report generator. You click on it, choose your dates. Of course, these should be the beginning and the end of a financial year. And then it lands in your documents, as you can see here. It's not ideal, as it's a list of your contributions, so it's a mixture of both personal and company contributions. Well, in my case, as I said earlier, I use my SIPP as a limited company director on top of my personal contributions. But if you're not a company director, this report will look much simpler and you won't need to do any calculating. Depending on the provider, these reports are more or less user-friendly. Normally, you should get a report like that at the end of a tax year, but unfortunately, I wasn't able to locate mine, so I had to produce this report instead. Not a big deal. And now you're ready to do one of two options. Option one, you call or write HMRC. It's so simple. And then you let them know you want to claim that additional tax relief. That's your option one. Option two, you complete a self-assessment tax return. Before you run out of the room and start screaming, please remember, because for whatever reason, many people are totally put off self-assessment tax returns. But trust me, it's very simple. I do it every single year and it takes me 30-45 minutes total, tops. So this is what you do. You log into your gateway account, your account with HMRC that lets you use their online services. If you don't have one yet, you need to register. It's super easy, trust me. I leave the link in the description of this video in case you have more excuses. Just put them aside and just take some action and do it. So assuming that you've already logged into your Gateway account, you look for the tax relief sections. It will appear when you complete your tax return. And the first group in that section, payments to registered pension schemes, where basic rate tax relief will be claimed by your pension provider, is what you're after. Pay attention to the sentence here, okay? Enter the payments and basic rate tax. Essentially what it means is that you do not deduct any tax, you just put the whole figure. So your contributions with the first tax relief that your SIPP provider added to your pension. You just give HMRC the total. Don't worry, the numbers on your report will already include that top-up. So it's more of a reminder really from HMRC than anything else. Once you enter these figures and submit your self-assessment tax return, you will get immediately a calculation. So HMRC will tell you straight away whether they owe you tax or whether you owe tax. I think this is the part people are really scared of. But if you're on PAYE, pay as you earn, the chances are you don't owe HMRC any tax. But there are huge chances if you really contributed a lot to your SIPP and you're a higher tax payer that they owe you some tax. So go and claim it. And if you do, you will get that tax return within a few weeks. I've completed my self-assessment tax return this year on the 1st of July. Yeah, I know I was early. There's this big campaign going on at the moment. File your self-assessment early. And my tax return arrived on the 8th of July. So more or less a week later. It's super quick. And this is it. This is the whole process. Very straightforward, nothing to be afraid of. If you're a high rate or an additional rate taxpayer, you really might be owed tax because of your self-invested pension contributions. So please claim it. You have 4 years for that, which means you do not procrastinate. It means you do more digging. And if you did make significant contributions to your SIPP in those past years, make sure you claim that tax back. If you think this is not a big deal, let me just tell you one thing. Higher rate taxpayers fail to claim 830 million worth of pension relief each year. So dare to take care of your tax and don't leave your money on this table. And if you're not a high rate taxpayer, but you know somebody who is, just share this video with them. And who knows, maybe they will be able to claim their pension tax return and treat you to a dinner. And that's a wrap. Thank you very much for visiting my channel and watching this filled with numbers video. See you soon.